So, first and foremost, what we're talking about today is going to be called the GEX, the GEX. Long name is gamma exposure. So, what gamma does is it is a derivative of the delta um, with regards to how much the delta can move for every $1 that the underlying moves. So if the SPY moves $1 and the gamma was 10 cents at the money, then the delta's increase would be 10 cents from going at the money to in the money. The gamma curve, which we'll see in a little bit, is skewed towards at the money options, which has some far-reaching implications that we'll get into. Some of the other metrics that we'll be talking about on a little bit further down the road are going to be like Van and Charm, which will deal with theta decay, or time decay as we call it, and Vega as well. Some of these concepts have to be talked about kind of all together, just because this is all going to be in respect to the options market. But all we need to know for what we're doing today is that at the money is what we're talking about, and gamma is a rate of change in the delta. Okay? So when we constantly look at the gamma, we're saying for every dollar that QQQ or the NQ or the ES or the SPY moves, we're expecting X amount of money having to go into the market, having to be injected into the market in order to move the price, that dollar. So we know that a certain monetary value has gone into the asset at that point in time, usually to the tune of a few hundred million or a billion, to make even a $1 difference on the ETFs like the QQQ and the SPY. And then when translated out to the NQ and the ES, you're looking at 50 to 100 points on average. So part of talking about gamma is I build these charts, and we see that there is positive gamma and there's negative gamma. Whenever you look at the documentation for gamma, it's always the same. You're going to see a lot of long gamma, and you're going to see a lot of short gamma. When I talk about it in the chat or throughout this video, I'm always going to refer to long gamma as positive gamma and short gamma as negative gamma, because I don't want to mix the terms of long and short into the gamma, because that's not what we're actually doing. So let's get into long gamma, or positive gamma in this case. Okay. What we're saying when we say positive gamma is that hedgers, institutions, big money, market makers, whatever, are basically hedging their position. Let's say they're buying stocks. That would mean they'd be selling futures, and vice versa. Okay, so if they're selling stocks, they'll be buying futures. That's when we're in positive gamma. Okay. One of the correlations to this happens to be that volatility decreases, or gets suppressed. So the days that we have range days, or the days that they don't quite move right, like the end of the month, March 31st of 2023, is a great example of a positive gamma day. We had these long moves or we had this like extended move to the upside, but it was really hard to get a foothold and to get in on pullbacks or to do anything related to the longs, just simply due to the fact that we were positive gamma, right? Every time they bought, the dealers were not assisting the move. They would actually be suppressing the volatility every single time there was a move, which made it hard for breakouts to occur. It made the pullbacks feel longer than they should have been at times. And these are the negative consequences of the positive gamma, and why we need to be careful under positive gamma is because dealers are not helping the move succeed, right? So think of it like, if you put half your money on the longs, and then you went over to stocks and you put half your money on the shorts, right? You'd create that what we would call delta neutrality across the board. Portfolio would be balanced, but the volatility would be nothing because we wouldn't be going anywhere. In contrast to positive gamma, we have the short gamma, or the negative gamma, as I'll be referring to it as. And what the negative gamma is similar to the concepts we had discussed on the OI videos before, where beyond a certain point we expected buyers to have to keep buying and sellers to have to keep selling, which means that under the negative gamma, we are going to have dealer assisted moves. Volatility is going to increase. The moves will be a lot cleaner to both the upside and the downside. Now, a lot of times when we're in the negative gamma territory, we have flipped from longs to shorts. And it's important to note that just because we flip from long to short does not mean that dealers will only be assisting shorts. Okay, so under dealer assistance, negative gamma, you will have the dealers attempting to both get long and get short aggressively in multiple areas. And we'll kind of get into the area identification, but you have to be prepared for both buying and selling. You're going to get deeper pullbacks. You're going to get extended moves. You're going to get these market characteristics like we're on a trend, even if we are sideways, right? That's how we get a lot of megaphones at times on patterns, or we get these like extended moves where it's like 13 candles in one direction. It's because we're under negative gamma and dealers are assisting the move. We almost never get those under positive gamma situations. So just to recap on that, and we'll see an example of that here soon. To recap, long gamma means hedging, less volatility. Negative gamma means dealer assisted moves and more volatility. Okay. Now, I think I'm going to skip most of this. I wanted to go into just this graphic here, discussing the gamma curve itself. And you guys can kind of see this as a bell curve. But essentially all this is showing is that your at the money gamma is where gamma is mostly going to be affected. So the further out of the money you get, or in the money you get, the less influence gamma is going to have. This is why we pair techniques with the gamma, like the OI, okay, for instance, because the OI at the money strikes is going to hold more weight, right? Or your bounces off of things at the money, right, on some of these gamma levels are going to hold more weight, just simply due to the fact that that's where all the gamma is currently sitting. Okay. and we'll get into more of these graphs later, but it's important to note that gamma is an at the money options metric. So over the past couple years, Goldman Sachs quants have actually released a few pieces of information regarding and relating to how much zero DTE options um, have increased on the volume. Okay. Um, the volume here is showing as, on average about 44% of the daily volume of zero DTEs. Hold on 1 second. We're gonna have to pause this for just 1 second, guys. Sorry about that. So, as Goldman Sachs has released this information about zero DTEs and how much of a foothold it's gained in the market as a whole, we can see anywhere from 34% to 52% of the daily volume percentage of volume anyway is from zero DTE options, and that's what makes this entire gamma exposure profile an important metric, is because we can actually see where market makers are attempting to get long or short based on this information, right? And where they need to put a lot of money towards, right? Maybe not enough to move us, 100, 200, 300 points, but they have to at least put enough money forward to move the market so that they can keep their, 100 million, 1 billion, whatever it is, portfolio intact and flush for the delta hedging. And the fact that we have a near 50% volume of options means that this is not something that's going to go away very quickly, right? We'll be able to watch this for years to come. Along the same topic, we have basically a new concept due to interest rates rising that was called row hedging. That was really an interesting topic where a lot of participants were not just balancing their portfolio on the zero DTE and various other places, but they were taking advantage of the interest rates call options, I think it was, because they're priced at a higher premium. So they're trying to play a lot more of the call-sided option strategies in order to take advantage of the interest rates rising. Which is a completely different topic. I don't mean to get off topic with that too much, but you guys should see that the importance of the options market in futures is pretty heavy and pretty significant over the long run. And that's what I'm trying to highlight here. There was one piece here. Well, when we talk about the gamma profile, all this information that I have been using for the last I don't know, 2-3 weeks consistently now has all been based off of a Goldman Sachs quant named Perfilieve from the UK. He has a very interesting Twitter as well if you guys want to go follow him. But I've posted the site that he talked about how to calculate the gamma exposure, what it looks like, etc. And we have some more things in the works to calculate kind of the gamma exposure profile so that it's easy for everybody daily, besides what I post in messaging queue for our group anyway. So this is the common graph that we're going to see for the gamma exposure itself and the profile. This is not something that I specifically post for my levels or anything, but this is essentially telling us that where the gamma flip level is. And what the gamma flip level is, which is this red line here in the middle, is the point in which we're going to run from um, negative to positive on the overall structure of the gamma. So when the numbers flip negative to positive or positive to negative, that's the spot that we got to be careful of. That's kind of our edge point. And beyond that point, we got a completely different market structure, so to speak. And there have been days where we have flipped uh, at least once, but sometimes two times. And they become very difficult days if you're unaware of it. You might think that a deep pullback is incoming when a shallow pullback is coming, or you might believe that we're gonna break out and we're gonna run 300 points, and all of a sudden it pulls back into the gamma level, right, or beyond it, and completely changes the direction of the market. And you might just say it's a bad day, it's whatever, but it's a changing of the market internals on a daily time frame due to the options market, and it's something that we can track. So with all of that, let's get into what I post and my thoughts on the structure of everything. The gamma exposure pieces themselves are not fairly difficult concepts to grasp as far as what it does, but now we get into the calculations and the levels, and it's a little bit different. So starting at the most recent, I have the two most recent days that I traded this, because I think they have some really good lessons in them. And sorry for my crude drawing. I didn't make it super professional, but um, in order to explain this, okay, the black X here is what I want you guys to focus on. This black X right in the middle. We started our day around the 13,076 on 4/6 2023. Okay, April 6, 2023. So the start of that session started around 13,076. Now, identifying the positive versus negative gamma here should be fairly easy. The negative gamma, where dealer assisted moves are going to be, are on the bottom, right, below this this zero line, right? And positive gamma or long gamma is going to be above the zero line. Now, with that being said, different characteristics are going to come out based on not just the OI book, but also these levels and what happens. So obviously when we see a high gamma level, like 13,034.75, that means there's a lot of gamma that's stacked there, a lot of at the money gamma that's stacked, a lot of money and activity at that level, so to speak. And I don't want us to look at this as the high gamma strikes are the most important thing in the world, because they're not. I would look at this as potential bounce points, right? If we were able to move beyond that. So what we want to do at the start of all of these charts is to create our bell curves, right? Find where the masses are, like these black lines that I have that are creating pseudo bell curves for us, right? Find what makes sense, and we really want to trade the edges of these bell curves. And we want to trade these edges in a similar manner from edge to edge, okay? So similar to my red line X here, right? That curves back and forth, right? The play was, if we were able to get past 13,034.75, right, which we were able to get, a little bit beyond that point, then the pullback into 13,076, right, would be important. We're one gamma strike past the gamma flipper range, okay? Um, the gamma flip range is just identified as the point that we flip from negative to positive. We want to kind of stay out of that range. So between 13,117.5 and 13,076 here, you have a gamma flip range, right? If these bars are represented by that particular number. Okay? So anything in between that area, we stay flat. We don't touch. Now, when we have this pullback into 13,076, what we're saying is that if it goes beyond this point, we're in no man's land. We're in a position where we don't really have a good idea of what the price can do or wants to do. Okay. And there's a few different strategies surrounding using the front strike and using the back strike. Okay. Due to the fact that we crossed a gamma strike further, right? We went one gamma strike over. We want to use the large gamma strike at the edge, at the front edge, 13,076. And we want to start our process for looking for a strategy of entry. We want to look for the OI book and what it's doing. All these things should coalesce, right? Once we found kind of like something that we want to use the gamma profile for, or the gamma strikes for. Had we stayed between 13,076 and 13,034, right, and we had pushed past the 13,076 point, then we would have had to look at 13,117.5 as potentially being an edge point before we had to switch the market internals to positive gamma only. That to say, this example is a little bit cleaner than that because we did push past the one gamma strike. Now, when I looked at this on the night of the 5th, the plan was pretty simple, right? Is that we had already made it to like 13,025, for instance. So what I was looking for was what around 13,070 to 13,080 could potentially cause me to say, hey, I want to get short on this. And I want to short it down to, 12,993, for instance. What would cause me to want to do that? So when I looked at our positioning for the night, we were at 511 million of negative gamma, which meant that dealer assisted moves were happening, or more likely to happen, I should say. So knowing that our gamma is negative, we have an idea of where we want to potentially get short at, based on how many strikes we moved, right? Because again, we want to trade this bell curve edge of 13,076, right? We want to trade it back towards 12,827, right? I was able to take a look at the OI book that I post, and down here we can actually see that we had some OI on the put side. The right hand column here is puts, the left hand column is calls, and we have strikes. I was able to see that we had at 13,080 a low amount of puts, and then 13,075 had quite a high number of puts, and also 13,070 had quite a high number of puts. So I knew, due to this graph here and due to that OI book, that there's going to be some high activity when we reach back to those numbers. Because again, at the money, the OI is going to act a lot stronger, which is what we're doing here, right? The gamma strikes and the OI together are a very powerful combination to tell you that, hey, we could hold this area, or we could push away from this area, or we could push over this area, right? In this case, what I was able to see was that we basically had 85 puts between 70 and 80, between that area. I believe the high of that was about 80, when the price actually did come back to that area. So all I had to do was find a position on my chart that I was okay with getting in at. Okay? What was my entry strategy? What did I want to do to try and get short? And where did I want to place my risk? Now, in this particular situation, what I had done was I had placed my risk at 83.75. I got behind the 80 mark, which was probably too close, to be honest. A little bit too close, but that's where I had chosen to get in, or to put my stop, is about 83. And I had chosen to start getting in around 65, as it runs into that train, that wall, at 70.75 for the OI book. Now we knew that 76 was the edge, so one of my entries needed to be right on top of this 76 because there was OI levels there. The other one just needed to be pretty much anywhere that was, close within 10 points that I could have used to make my 2R come to life. And that's really subjective, can be whatever you want. But essentially here we saw 13,080 was the absolute high of that particular position. And now we can start talking about what's going to happen as we move to the other side of the bell curve. So as we move to the other side of the bell curve, from this right side to this left side, a few things are going to happen, right? You can have areas of slowing where price has a hard time moving through that area. So typically what they say is when you're starting on one side of the bell curve, that's acceleration. As you peak, right, you start your deceleration process as you come down the curve. Similarly, you can have a slowing period when you go from a period of relatively high gamma, like this 12,993, to relatively low gamma at 12,952. So what I had ended up doing was I had taken my first entry at 65, right, where my stop was at 83, and I had done my 2R for my first exit, which put me somewhere around 13,021, right in between these two gamma strikes. And for my runner, instead of trying to figure out, exacts, right, like where exactly are you going to end up at, right, I had said 993 is going to be the drop-off point into the slowing period between 993 and 952, right? So this slowing period in here, I said I want to take the conservative approach and get my money out, basically. And sure enough, what ended up happening is I got both of my exits, and after 993, we slowly degraded down into, I believe it was 70, I think it was like 70 something that we had degraded down into. So it wasn't all the way down to the 952 strike, but we knew that there was going to be less activity as we lost gamma value, right, and moved back towards that zero line. Now you'll see this is common when you start looking at this more often, is that as the gamma strikes decrease, a slowing effect will be in play in the market. You'll get less movement, you'll get a lot less volatility, regardless if there's dealer assisted or not. You're just going to see a slowing from what you were previously seeing. Okay. Similarly, if you're going from low gamma strikes to high gamma strikes, you have to also be careful because, like for instance, on the upper side here, the positive side, right? What you're likely to see is that high gamma strike, as you're running up the chain, is almost like an exhaustive period. Now, not always, but a lot of times it's an exhaustion. So you might be able to crack 241.50 here, right? But when you get between 240, 150 and 283, you're going to have a significant slowing effect that occurs uh, due to exhaustion, even though you're not all the way to the other side of the bell curve. So you have to be careful with some of this, and realize that, these high levels of activity can cause you to have a slowing effect, which can throw your stops, it can throw your entries, it can throw all of your metrics off very quickly. So you typically want to try and stay away from those until you can find one of these high gamma strikes that might um, allow you to back up to back your thinking up into them, basically, right? Build a profile on which direction we should go based on where the opening price is and what's going on around you, and then you'll have a better idea of how to back yourself up, essentially. So one of the things that that I really liked seeing about the gamma is that as we had moved past the 993 strike, right, and gotten again one strike away, had we come back, 13,034 with its high gamma strike is going to also act as a barrier, just because we're going to have dealer assisted moves to the downside. So you had a chance for a second entry to the short side at 13,034.75 that could have rebounded us down to the low 900s, right, where we would again see a significant slowing after 910. So these are the ways that I read the actual stuff that I'm putting out, and this is not something that you're gonna understand in one go. Like, you need to see the market move around the gamma strikes so that you can get kind of a feeling on your own of what we're seeing. The main thing that I could tell you is that draw these bell curves. Every time you see my posts come out with this stuff, look at where the bell curves are. Look at what the price does on the edge points, right? Specifically, the edge points of the bell curve. Don't worry about the middle pieces as much. Worry about what happens, what entries, how far you can go on the bell curve specifically. And that's going to help you a lot to identify what type of strategies you can put in place for the gamma profiles.
Couple questions. Do you mind?
Yeah, go ahead.
So, when do you pull the data in? Like, when do you actually pull in the data and do your analysis? And I mean, I heard you talk about, obviously you pull that data in, you identify the curve, and then as you might position yourself throughout the course of the day as you see price moving towards the numbers here, like towards the curve or through the curve, right? Just accelerating up and then decelerating down, right? Yep. How does that data change throughout the course of the day? Meaning, if you were to go back and do a reanalysis of that data, like, I mean, what's happening behind the scenes as price moves through that curve, through the gamma, and it might accelerate and move to a price, right? All the options are getting absorbed, taken. I mean, I'm not an options player. I don't fully understand options, so you're going to have to.
Yeah.
But I mean, as it moves past that price, right, and the move has happened, if you were to go snapshot, the gamma data, then is the chart going to look completely different now because all those options have been absorbed or taken? Or
so let's start back a little bit to the first question there, which was, when do I pull the data? Right, I pull the data in Globex. Via TOS, I have a spreadsheet, an Excel spreadsheet that allows me to pull all the data in at once, and I'm able to do my calculations based on that data that's updated at the end of the day. So I'm really targeting kind of end of the day to pull my data. So anywhere from close, the actual close of QQQ and NQ, all the way to London Open, essentially. You are right, is that as we move through the day, things may update, they may change However, your outlook typically is not going to change once this graph is built.
Mm-hmm.
Mind you, what I said at the beginning, where it takes billions of dollars to move this thing past some of these gamma strikes. Okay. In this case, I'm pulling directly from the QQQ, and typically we see anywhere from a few $100 million to $1 billion needed in order to move the price even 1 point. Meaning that yes, some of these gamma pieces will get bigger or smaller, but the general idea is still going to be intact across the board as the day goes on. The only change is that after the day is done and the options expired, the gamma, the delta, and all that stuff is kind of all over the place. So you can't really depend on it per se to give you like a recap of the day afterwards. Like you're just pulling the next day's gamma and moving forward with it. So think of it more as forward testing rather than back testing in that case. But nothing really changes day to day for it. Like you pull it in Globex, you use it through the day, period. Mind you, this is also, as far as I'm concerned, this is kind of more of a sentiment indication, right? More than anything. So you might have like your environment indicators, you might have your strategy, right? And your risk parameters and all that laid out, which is great. This is meant to go over the top of all of that and give you an outlook on direction and dealer assistance or not, basically. And that's some pretty powerful information because taking the VIX, for example, which is something I watch as well, right? If the VIX decorrelates, how would you know that? How would you use or trade the rest of that day if the VIX is a major component of your environment and you know it's decorrelated? The simple answer is that you wouldn't be able to trade that day. You'd have to stay flat or risk getting blown up because you have less of an edge in the market, right? This is meant to be able to cover that gap as well, in that roughly if the VIX is acting squirrely or is decorrelated, you at least have the gamma levels to tell you why it's decorrelated or what's going on. And we've seen before where VIX is going up and price is going up on the NQ, right, or the ES, and everyone's going, why is this happening? What's going on? And we're just in negative gamma, right? The gamma, the options that are coming in are telling us to, stay short or to go long or whatever. But the VIX is also doing the same thing and going with price. You don't need to rely on the VIX with this in order to find yourself a position that's secured, essentially, because this is the sentiment and the analysis that the VIX would identify and help you with. So it's good to use the VIX as a filter, right? And this allows you to take your thumb off of the VIX with like the cloud or with the like putting levels on the VIX, etc. You'd be able to take your thumb off of that a little bit, put it on the gamma for those type of things, and just say, hey, the VIX is short with me or the VIX is long with me. And that's that's pretty much the level that you have to go to, and that's it. So hopefully that answers that question.
Yeah, that helps. Thanks.
Okay. Any more questions before I move on? Okay. So we'll go into... Cass did have a question. He asked, how do you draw the bell? Essentially, there's no standard way to draw the bell curve. I typically draw it around the biggest sectors, right? I'm interested in the biggest movements near where the opening was. So I'm not super concerned about like catching all these little ones that are way out there and whatnot. I just want to get like the general area, right? Because these are going to be like, 400 or 500 points across. Um, and typically less than 1% of the days move more than 500 points in any one direction. So you're typically just trying to get a bell curve around the denser gamma areas, right? So like for instance, the negative gamma here, I put the edge of the bell curve. I could have gone one more over, I guess, but essentially I captured the main negative gamma that was there. So, okay, we'll move on from that. So, this was one that I did on, I believe this one was the 4th, April 4th, at night. And this was for the session of April 5th. Okay. Um, as you can see, I built the bell curves for the most gamma that I could possibly squeeze into it, and identified areas where there might be slowing. I identified areas that might be repulsors, right? Like the absolute low over here, because it's near the other edge from where our price started, which was the little X. I wanted to identify kind of where price could bump into and have a relatively high chance of bouncing off of. And I also identified an area where there was potential slowing, right? As I said before, when we move from high gamma strikes and we lose value on the gamma strikes as we go, um, that a slowing effect will be in observance essentially. And that's what would happen, is that slowing effect from 13,021 down to 855, had we reached 855, we would have been so slow reaching that area that the high gamma strike and the high activity there would likely act as a barrier. So again, the plays here from both sides, right? We started in our gamma flip zone, right? 13,229 to 13,270.5. The area between the positive and the negative gamma, where things are more shifty, so to speak. So, assuming we were to go down, right, and be short bias, right, so left on the chart here, we would have to see one of two things happen. Number one is price needs to reach 13,187, or stay somewhere between 187.5 and 229, and then break the 229 to the upside, where our edge is going to be 270.5. This is where we would look at 270.5 on the OI book and various other places and say, I do not want to see even a couple points past 270.5. I know that that's kind of my edge and where I want to be positioned. So I'm going to be looking heavily at 265, 260, 270, and see if I can find a reason to get short at that area, because that is going to be the absolute edge of what we're doing, right? Now, in the case that we had broken the strike price of 13,187.5 and say we get to 13,175, right, for instance, our edge becomes different. Our edge becomes 13,229. We do not want to see the gamma flip zone again, because we've gotten more than 2 strikes away from the gamma flip zone, right? Or more than a strike, whatever you want to consider it. So then once we've broken that 187.5, we're looking for reasons to get short near the 30 mark, the 20 and 30 mark. In which case, on this particular night, what I had done is we had made it to 176, and I had positioned myself to get short at 13,222, which had a fib retracement, and I had put my last order at 13,230. And I believe the high there was about 33. My stop was at 43.5 because I like to get usually a full strike price behind the price. So it had OI data there. It had the bounce. We had gone towards the peak, one gamma strike away. We had, we needed a pullback in order to get the momentum necessary to carry us into the peak of the gamma strikes here. And that's an important concept for us, is that after we hit the 222, the 230, I had taken my 2R probably somewhere just past the 187 strike, and then or near the 187 strike, and then I had targeted 146 for my next out. However, looking at these gamma strikes, you can see they're all relatively the same interest, right? You could have targeted 13,021.5 just due to the fact that all of these were similar, and you wouldn't expect a slowdown until you got towards this 13,063, where you might start to experience your first bit of slowing down due to the deceleration after the peak, right? And due to the lower gamma strike values, right? And definitely after 13,021.5. Okay? Those are all things that you could have done. And I believe the low on this particular day was 13,000 flat. And we had jumped up off of that. So had we looked at a positive gamma type of day, right? What we could expect out of a positive gamma type of day is that we push past 13,311. We push into the 353. Hopefully we break it, right? We would have a little bit of dealer assistance between 270 and 353, which means that it could be a little bit slippery, right? Had we made it past the 353, then the pullback into 270 would make the most sense, where we could get long and we could stay long all the way up into the slowing of, the 400 level, basically. And I unfortunately don't remember the day as a whole as to what happened, but that would essentially be the target. But you can see as we decreased from the gamma levels at each strike, you're going to have a slowing effect. And that slowing effect is going to be harder. You're going to have more exhaustion, right, as that slowing effect happens. Meaning that your absolute edge and your absolute high ends up being this 477.75, because it's the first time that you have more gamma, more interest, more everything after that slowing effect has taken effect. Looking at the same day, we had negative assistance right off the start of the day, which means that my instant bias is going to be towards the left edge of the chart, more towards shorts. Even though it doesn't necessarily mean shorts, it means that I believe that if we are going to have negative gamma off the start of the day, that they're still probably thinking, they need to balance us out somewhere below us from the start of the day. Other than that, that's pretty much all I have. So if you guys have questions, now is the time to talk about what you guys want. What questions do you guys have?
So starting out, you would say like as you start your day and you're trying to get like an environmental look of what's happening for the day. One of the biggest keys is finding out where the gamma flip is to find out if it's going to be a positive gamma or negative gamma day to start with, right? Like you would agree with that assessment?
Yes.
Okay.
Your starting price on the day is very important, because assuming that you're starting inside of the gamma flip range, right, which is a typical starting point for us, where there's positive gamma ahead of us and negative gamma below us,
Mm-hmm.
right? Assuming that that gamma flip is where we're starting, right? We need to move a certain number of strikes away from that area, usually at least one strike plus away from the area, before we start to look at good bounces, before we start to see like really good edges in the market. And if we stay within that gamma flip area, then it's kind of like a no man's land. Like you're not gonna get clean moves. Nobody knows what's going on. Nothing's happening. There's usually lower volatility involved, because nobody has any idea of which way we want to move. So yes, very important to identify where the gamma flip zone is and where you are in relation to that zone, and whether or not you think that we're going to fall back into that zone.
And so far, based on what you've seen with the gamma charts you've looked at, is there such thing as a good-looking gamma chart and a bad-looking gamma chart?
Yes. This particular gamma chart that we're looking at right now would be considered more of a good gamma chart, where you have, a large section of strikes, um, uh, that are both negative and positive, right? There have been some days already where you have negative and positive, just like every other strike. It's negative and
Right.
positive. And that makes it really tough to trade through, because it could mean pullbacks, it could mean slowness, it could mean a whole bunch of different things. But the dealers are going back and forth saying, like, hey, we need to hedge, we need to short, we need to hedge, we need to long, we need to, it's always changing, and you can't get a good beat on where you should be positioned. So typically it's smaller entries, smaller tries, and, you know, even to the point of being flat. I think Monday of this week was a flat day for us, just due to the fact that the gamma chart was, one positive, one negative, one positive, one negative, throughout the day. So it's just easier to stay flat and not deal with it than it was to do anything else.
That's also like probably one of the biggest key takeaways is if once you get good enough to identify like good gamma levels or good gamma charts, it kind of tells you like what to expect for the day so that you don't. Because once again, this is, to me, is also much more of a like larger, broad, as we say, environmental look of what you expect the day to look like or what you feel, rather than like, buy here, sell here. It's not necessarily like an entry strategy mechanism, but rather like what to expect or kind of have a feel for going into the day about what's going on in the environment around you. So.
Yeah, like I said, is it's completely sentiment, and one of the things I probably didn't get across as clearly, while I was explaining it, was that I'm looking for areas to put my back up against the wall and say that beyond this point, we have some serious problems with the internal structure of the market. And like this picture here is a perfect example. We moved one strike away. I was like, that's a huge gamma strike that we just blew past, that we just moved past, right? I mean, we got like 15 points past it, and then we started advancing back the other way. And I'm like, well, if we're going to go to the other side of the bell curve in this case, right, and we have such heavy negative total gamma as a whole, then where's my edge to get short?
Mm-hmm.
I was like, well, there's only one gamma strike left before we're into the gray zone and things flip positive. And gamma at the time I think was increasing as well to the negative side. So you had an increasing negative gamma that was coming in. We were advancing back towards 13,076, and I was like, okay, what does the OI book look like from like 60 to 80, right?
Yeah.
And I'm going, well, 60 to 80, it's like two puts, right, that are, basically 30 in OI. and then you have 180 in a small little section of 70 to 75, right? And you're left with the feeling like, well, my edge is 76, right? And we know that it can't really go beyond 80 unless we're like really, really wrong, because that would be too far out of the gamma strike. Like, we don't want to see it 10 points past technically.
Yep.
So, it was an easy decision for me to say, like, I know my stop needs to be near 83, 84 ish. And I know that my entry needs to be near 76, flat out. But how do I guarantee where my entry is going to hit, right? What other factors do I have? And that's when I start looking at, like, okay, what's the position of the VWAP? Where's the 1 minute orb? Where is where are the fibs at for an extended move? And I had, like, I think I had a golden zone fib, like a 65% golden zone fib that was backing up against the area as well. And I'm like, that's pretty much all I need to say, like, if this breaks, we're just in a different internal market structure altogether. I'm up against the edge right now.
Yeah.
And I think that's one of the important factors that the gamma gives us, is that not only can we see where there's a lot of interest, right? But we can actually say, like, when we get back to these specific gamma levels under these specific conditions, the OI levels are going to work with us too.
Yep.
And that's something previously that me and you have talked about, is that those OI levels are great, but they're not everything, right? That's why we still have to use so many other environmental pieces. In this case, we can say, hey, 50 to 100 on the OI book is enough to move the market in our favor for quite a few number of points when the gamma is supporting it. And again, it's all due to the fact that at the money options, right, the OI, which is part of the gamma calculation, right,
Mm-hmm.
is stronger than,
Yep.
Out of the money or in the money, to a certain degree. So all of these factors mean that, gamma and OI together is the play, right? And then you move into your strategy, your entry, your risk, all your other modular pieces that you built.
Yeah. Because I think we get lost. We get so lost always looking for the microscopic elements that we forget about the whole macroeconomic. And I think this is the macro elements of, like, trading that's just as important.
Yeah, and we've done videos in the past, some of Magnum's videos that everyone has watched for the most part, where he talks about using the VIX long term, and I think he's mentioned the bonds in there a few times.
Yep.
And he uses levels for those, right? And this is no different than that. It's just this particular piece influences us directly, so we don't have to look at the yields and the bonds and all that as a longer term structure, unless we're wanting to, or swing trading, or looking for extra confirmation. We can look at this in its own enclosed compartment and trade off of it with levels.
Right.
So, any other questions?
I think you had said the other day the new data comes out at like midnight Central. Is that right?
So the OI data from the CME comes out roughly 12 a.m. Eastern time. So if you don't have a good way of identifying or using OI, then you can go to the CME heat map site and use their stuff for free.
Okay, so you essentially wait till after that time to pull your levels.
I don't have to, because I have TOS. TOS gives it all to me by real time, basically. So by the end of the day, I know what the outlook's going to be for the next day.
Because
Because all the stuff
would
goes
you?
all the stuff goes in end of day at the expiration, right? Everyone's positioned for the next day by the end of day. The difference being the CME and CBOE and all that, they post the data for all the gamma and the OI and things like that, but they post it late, just because they're building, they have a complex tool essentially that they're feeding data into.
Could you do like a walkthrough on how to do it on TOS? Because I have that as well. They haven't closed my account yet, so I'm still living.
Yeah, for TOS, you just need to come into the trade tab of technically the QQQ would be the better one. And what you're gonna want to do here with your TOS is starting at the quarterlies, which are in this case I believe June. Yeah, so starting like June 16th, you're gonna want to expand all of these different weeklies and dailies and whatnot. And then once they're all expanded, make sure that your columns that you have are gamma and open interest, and then implied volatility if you want it, or something else. It doesn't matter. Gamma and open interest are part of the main calculation, so you have to have those on. If you want to change the layout, you just need to click the layout button up here and select customize, and then you can move whatever you want into the current set and see it for both calls and puts. Once you've actually set all that up, you have all strikes. You're going to want to click on this button up here in the top right. That's like 3 lines. And you're going to want to export to Excel. Now when you export to Excel, I've already done this myself, but when you export to Excel, what's going to end up happening is it's just going to copy everything to your clipboard. So you're not going to see anything other than it's going to say that you copied it. You're going to open up a spreadsheet, a fresh new blank spreadsheet, click on A1 and paste the information in and start adjusting your stuff. Now, I have a few more things here than what you can do, but I do have Perf Leaves link that we talked about a little bit earlier, which was this guy here. And this particular link, how to calculate gamma exposure and 0 gamma level, has everything you need to build the spreadsheet from the ground up, so that you at least know how to build the spreadsheet, and then I can fill in the rest of the information for you if you reach out after you've looked at this link.
Yeah. So is that like that one I made for you a long time ago, where will it auto update the data if you just open
That is correct.
and open the spreadsheet?
Yeah,
Okay.
It's the RTD function.
Okay, cool. All right, yeah, I'll have to give this a read later.
So I put it into training again so that you can easily find it. It's worth doing it every day if you have TOS, just to get used to all the data calculations, how to build the charts, how to do all that. And it's a pretty good read as well on how to calculate everything. So it goes into some programming too that you can pretty much skip or try. Other than that, yeah, it's not really much more to it.
Okay, and so using this method with TOS and Excel, you would just open it after the day closes, and then you're good to go.
Yep. Yeah, I open my TOS and then anytime in Globex, and then open my spreadsheet. Click once to get all my updated data, and then all I'm doing is building a pivot chart based on the data, right? So select the top of it.
Okay, cool.
Go down and insert and pivot table. Once I've done that, it builds me my pivot table, and I make the graphic after I put a few filters on, so that I can just see what I'm interested in for the day. And I only do this for 0 DTE. I do not do this for the month. I don't do it for any other time. Just the 0 DTE.
Oh, so in TOS, you would have had to make sure you only selected those then, right?
I mean, you can if you want to. If you want to pull it every day, I'm pulling the quarter so that I can just delete data out of the spreadsheet later on.
Oh, okay, okay,
So
gotcha.
I can delete all the rows and just get the next set of information up. And I can just do it for an entire quarter. That way, I only have to rebuild my data section of my spreadsheet once a quarter.
Okay, yeah, good plan.
Yep. Anything else you guys are curious about?
Appreciate the info.
Yeah, I'm gonna have to replay it, especially the bell portion, because right after I asked that, someone walked in. So
Yeah, the bell curve is simple, right? You're just trying to get the most number of gamma strikes in as possible that have high levels of gamma, essentially, and trade it from one side
okay,
to the other.
gotcha.
You're going to have 400, 500 points on the NQ between each of the bell curves, right? That you can build. So, you're just looking to build so that, you're getting most of the negative in one bell curve, most of the positive in one bell curve, essentially. Really simple stuff.
Gotcha.
And I'll be
And so,
I'll be building these every night for a while. So you'll be able to compare and contrast against my stuff as well.
okay, and then if it's one of those ugly days where it flip flops like every other strike, you just wouldn't draw a curve then, or what would you do?
Probably not draw a curve unless it made sense for some reason to draw the curve. Like I was able to come up with a reason for it, but more than likely there's just no curve that you would draw.
Okay, cool. Appreciate all the info.
All right, I'll end the recording of that. Thanks for sticking around to the end, guys.